Cool. Well, welcome, guys. This is our Mortgage Insider call. So today's topic is rate buydowns, but I want to preface it with a little bit of market info. So I'm going to go over home prices and market update, both locally and national stats. And then we'll talk about affordability, which when I dug into the affordability statistics, that's kind of when I realized that that's our biggest challenge right now is how affordable homes are. And so some things that we can do to try to combat that and make homes more affordable for the buyers in today's market is some different rate buy down strategies. So we'll go into that. And also I have a little forecast on mortgage rates just from some different sources. So I'm excited to share that. So jumping right into it, for home price at the beginning of the year, we have 19 different places that come out with forecasts for what they think real estate's going to do in the coming year. And this is a little chart. I didn't make this. I found this somewhere. I forget where, but everybody except for one is forecasting that home prices will continue to go up this year at kind of shorter, lower rates, but the average of all 19 is 3.1%. So our expected appreciation rate for the entire country for real estate 2025 is about 3%. Now, some places that can vary really wildly, and I'll show you some local Yuma stats, but some places are actually going backwards and home values are going down. And other places it's going up much faster than the average. So one thing that's keeping the home prices strong and continuing to go up, even though interest rates are high and a lot of people can't afford homes, is this demographics of the country. So the average age of a first-time buyer keeps going up, and it's now 38. This chart shows you back 33 years, but now they're saying the average first-time buyer is 38 years old. So kids are staying at home longer and getting into homes later in life. Well, part of that is that's going to continue because there's more babies born in the coming years that are going to become homebuyer age in the next decade to 15 years than there have been in previous years. And because of that, we have a housing shortage. The other part of the housing shortage is just lack of inventory of new construction. So this shows you the orange bar is new homes being completed or housing units being built, and then the blue is households being created. So as all those kids grow up and become homebuyer age, or as people get divorced or split up, and you have one household that now needs two different places to live. I mean, my kids are all growing up and moving out, and so I'm part of this, contributing to this, where we have more households being created than we have houses being built or housing units being built. And that's been a problem for like 15 years now. You can see anytime these blue lines are taller than the orange, that's telling you that more households are being created than housing units to put them in. And so you combine that over the last 15 years of not building enough houses to keep up with this demand, and we have a real housing shortage. I think it's Freddie Mac that came out with the um, estimate of something like 2.4 million housing units short of what we actually need right now. And maybe that's part of why people are staying at home longer. Well, here in Yuma, okay, I showed you the 3% appreciation rate nationwide. This is our average sales price. If you look at the blue line here, this is just single family homes in Yuma. And from 23 to 24, it went from 311,000 to 335,000. That's a 7.5% appreciation in Yuma. And then the black is the market as a whole, including manufactured homes, and that's like 9.8%. Yeah, almost 10% appreciation that Yuma has had. So it's much stronger than a lot of other places. Now, the flip side of that is that, well, here, let's just zoom out a little bit and look at it on a monthly basis instead of just yearly. And when you look at it monthly, you could see this is the last few years. It's kind of, we're definitely not crashing and it's going up a little bit, but it looks pretty flat overall. And even with this pretty flat look, we're still up almost 10% appreciation. And I'll zoom out a little bit further in a minute, but I wanted to show you the other side of that, which is how many homes we're selling, which right now we haven't been selling as many homes for 3 years in a row now. If you look at 2021, we peaked out with 3691 sales in Yuma. And then for the last 3 years in a row, we sold less than that. Well, that reminded me of 2006, which was when kind of the last peak we saw where we had 1,811 sold. And then we had 4 years in a row with the market crash where we sold fewer homes than that for 4 years. So if that holds true, then we have, if that holds true moving forward, then maybe this year we'll see fewer again, and then it'll start to shoot back up by 2026. We'll see. I don't know. Um, Now, I also thought it was interesting to look at this yearly because I'm kind of looking for trends and say, okay, how many homes have sold? You look at it and it's really like, okay, 2023, it is a little bit lower, but if you look overall at this, I don't really see any overlying trend. Um, so let's zoom out a little bit further. This is going back to 2018, so we're talking like 7.5 years of data here. The average sales price um, monthly, you could see it gradually went up, and then it's been doing this little up and down thing. So, I mean, it's possible that somebody's bought a house and they're upside down on it, but it's pretty unlikely because overall the home prices are still continuing to go up. I mean, they're not skyrocketing, they're not going up as consistently as they did in previous years, but they're also not crashing. And then when you look at units sold in this light, also, I think it brings a little more clarity too. You look at this monthly, okay, you always have these kind of seasonal adjustments up and down throughout the year, but you can see 22, 23, much fewer sales, and then it seems like it's kind of recovered and we're back to selling homes again. A couple other stats when you dig into the local market that I think are super relevant and interesting to watch monthly is percentage of sales with price reductions. So this means they listed it for a certain price and then they had to lower the price before they got it sold. Well, in May, it was about 20% of listings that were reduced, which is pretty low from what I see on the news and in the different websites that I'm reading on nationwide stats. That's one of the big headlines that you see everywhere is, oh, huge price reductions. 20% is not that high. You can see we've been between 20 and maybe up to 30% this year, somewhere in that range. The other thing that's happening is seller concessions towards buyers' closing costs. And the number for May was 75%. So that means almost every transaction is getting the seller to cover closing costs for the buyer. I was surprised that that was so high. I've been telling people it's around 50%, but you look at this, it's been more than 50% for the last couple of years. So 75% in May had seller concessions of some amount. Now you would expect, I mean, that kind of shows that it's a little bit of a buyer's market where the buyers are getting seller concessions. The sellers are having to lower their prices in some cases, 1 in 5. So are homes sitting on the market longer? Well, yeah, they are a little bit. And you can see it's been hovering around maybe 100 days on market from the time you list it to the time it closes and sells into the other person's name. You have about 100 days. But the list to sold ratio, which means, okay, once you get it to the final list price, how close to that does it sell? It's at 99%. So once you have it listed for the proper amount, it tends to sell for really close to asking price, even though it most likely are going to have some concessions to the buyer. Okay, so when is this going to end? When is the market going to change? And I found this chart, thought it was super interesting, and this quote that says, challenging affordability levels are forecasted to stay at extremes through year's end. So it's likely with high home price, I mean, there's just no indication that home prices are crashing anytime soon. There's also not a lot of indication of mortgage rates going down drastically anytime soon either. And so right now you have super low affordability levels. Affordability level means how easy is it for someone earning the average income to qualify for the average house? And these numbers down here in the 70s and 80s are really bad. I mean, this is a forecast that Goldman Sachs comes out with, and they're just forecasting it to be low throughout the end of the year. Now, the National Association of Realtors does a similar statistic, and this is one, they come out with this every month, so I like to follow this one. And on this chart, you could see this kind of where there's a line right here at 100. That would mean the average person can exactly qualify for the average house. Well, over the last decade or so, it's been super high, almost to 200. And there were some months where it hit 200, where you could see the average person's income is double what it would take to qualify for the average house. Well, when it drops below 100, that means the average person just can't afford a house. And for the last 2 years, 2023, it was 96.9, 2024, it was 98.8, and now the recent numbers are back up to like 103, which still is just barely squeaking by. And the way they do the math is with 20% down, which we know most of our buyers are not putting 20% down in today's market. So anyway, affordability is challenging, but affordability is also very local, and it varies wildly from place to place. So I just looked at a few local markets here in Yuma. Our number is 115, which is actually one of the highest affordability numbers in the country. So the Yuma market is, relative to other places, one of the most affordable places to live and buy a house in the country. You compare it to Maricopa County at 84, Pima County and Tucson 93, and I mean, we're one of the only ones that's over 100. So it really does vary drastically from person to person because household income varies, and then sales prices in different places also varies. So what's likely to happen with interest rates? Well, this is the just a quick look at the bond market, and it's up and down every single day. So there's not always just one rate of this is the going rate. It's really hard to pin that down. But I follow Lawrence Yun from National Association of Realtors, one of my favorite economists to listen to. And here's his quote about interest rates and the forecast of what they're going to do in the future. He said, "Are we going back to 4%? Unfortunately not. It's more likely that we'll go back to 6%, and that'll be the new normal, bouncing around between 5.5% and 6.5%. So I found 3 different places that are putting out quarterly estimates of what they think, or forecasts of what they think rates are going to do: Fannie Mae, the Mortgage Banking Association, and Wells Fargo. And all of these are forecasting slightly lower rates by the end of 2026, but nothing too drastic. Like you look at Fannie Mae, they think we're going to be at 6.1% by the end of this year. I wonder if they'll revise that, or, I mean, there's a chance that we hit 6.1. I think that's pretty aggressive. We'll see. Mortgage Banking Association, 6.6. I mean, for a little context, right now we're at 6.89, so just below 7%. So if we get down to 6.1 or even 6.6 by the end of the year, that'll be an improvement from where we currently are. But so the MBA says 6.6 by the end of this year, 6.3 by the end of next year. So just a very gradual decline, but nothing too crazy. So all signs are pointing to rates staying high for a little bit longer. Okay, I wanted to show you kind of how rate buydowns work. And this is something that we walk our clients through. And every day when we go into quote interest rates, this is from yesterday. This is just FHA rates from yesterday. You could see the rates go from 4.5% all the way up to 6.875, and it actually goes higher. I just couldn't fit it on the screen. So the rates as low as 4.5 are actually available out there in the market. So you have to be careful with customers, especially with the internet and online rates, that the rates you're likely to see advertised on different places are going to be on the low end. And that's because it looks better. It's kind of, I call it clickbait marketing, and it just looks better in marketing to have a lower interest rate. The math is more pretty and the payments are more attractive to the buyers. And so watch out for those low rates, because the trade-off is to get the lowest rate, you pay a higher cost. And so what we try to do is show our customers the right combination of interest rates and closing costs that's going to get them to where they want to be. Because yeah, they want a certain monthly payment, they want a certain interest rate, but they also don't want to come in with more than a certain number out of pocket. So like here's a comparison today where or yesterday's numbers anyway, 5.875, you look over here, it's costing just under 3 points. So if someone wants to buy the house for $400,000, getting a 5.875 rate, they're going to need about $26,000 out of pocket. Now compare that with the 6.49, which is pretty close to no points rate, and their payment's going to be $156 higher, but they're only going to need $14,000 instead of $26,000. So it's a difference of $12,000 in closing costs in order to go from here to there. Anyway, when we have somebody that has the money or the seller concessions to buy down the interest rate, what we do is we run a break-even analysis. And so we say, In today's market, the longest I think they're likely to keep the loan is probably 24 months. It's possible that they'll keep it longer and we can run this for any time period that they want. But over 24 months, what you see here is it takes into account how much you're going to save in interest and payments, but also how much it costs you up front to do that rate. And we're going to run it and say, okay, in this case, if you only keep the loan for 2 years, you're actually going to come out $6,500 ahead by taking the higher interest rate, paying a higher payment for those 2 years, because it's just not worth the extra closing costs to buy down the rate. Now, if the seller's covering those costs and you're able to do it without extra money out of pocket from the buyer, then these numbers change. Also, if they keep the loan longer, then the lower interest rate always wins out. So that's something that a lot of times the banks will run numbers based on 30 years because it's a 30-year loan, but that's just not it's not realistic for most people. Okay, so let's talk about another strategy, which is temporary buydowns. So when you hear temporary buydowns, it's usually talking about a 2-1 buydown. That's the most common, but there's other ones as well. There's a 3-2-1 buydown. There's a 1-1 buydown. There's a 1-0 buydown. And the way these work is they're temporary in nature. So the numbers just mean like a 3-2-1 would mean you're going to get a 3% lower than market rate for the first year, 2% lower for the second year, 1% lower for the third year. And the cost of doing this is exactly the amount that the buyer is going to save by doing it. So I just ran this little cheat sheet on different prices and said for a 2-1 buy down, so let's say like a 400,000 2-1 buy down, if they're going to do an FHA loan, it's going to cost about $9,000. And that can't be paid by the buyer. It has to be paid by the seller or the lender. And so most of the time, what we see is using seller concessions in order to cover these fees. You're going to need $9,000. It goes in to supplement the payment for the first couple of years. Now, you see a lot of home builders using these types of strategies to advertise low rates and low payments for their buyers if they buy their houses. And so, like, here's an example of one that we did for a spec home that Jacobson has for sale right now. Reduce payments to the buyer for the first 2 years. So basically, the seller is paying money up front to help the buyer to have a lower payment for the first 2 years that they're going to be in the house. So in this example, like this house is listed for $344,200. If you had an FHA loan at a average rate of 6.75 right now, their payment for the buyer is going to be $2638. So that includes taxes and insurance and everything. If they could get a rate that's 2% lower at 4.75, then their payment would be $2209. So the cost of that, or the savings to the buyer, is $429 a month. So we multiply that by 12, that's $5148 for the first year that they're going to save. And then the second year, it's going to go to 5.75 rate at $2419. So they're going to save $219 a month. So you multiply that out. The total savings is going to be $7785, which means the total cost to the seller also is $7785. Okay, we had a question. When that expires, the rate goes to whatever the current market. Okay, so what happens is it's a 30-year fixed rate mortgage. So in this example here, it shows your years 3 through 30 are going to be 6.75. So it's a little bit different than an adjustable rate. The rate is set up front, and actually the interest rate on the note of the mortgage is the rate for that 3 through 30. So it would be 6.75 in this case. That's the actual rate they're being charged. What's happening is we're taking this $7785 of money and we're setting it aside kind of in an escrow account. And then every month the buyer's going to make the $2209 payment. $429 is going to come out of the escrow account to cover the rest of the payment. So they don't actually get the 4.75 rate. They get a 6.75 rate. And then we're just subsidizing their payments in year 1, subsidizing their payments in year 2. And then once those funds are out, then they make their full payment. And it's important to note that they actually have to qualify at the final payment, the $2638 monthly payment. So anyway, this is kind of a general, these are accurate numbers, but general based on sales prices. Now, something you can do, I mean, you look at that and that was 60 or 77, almost $7,800 of cost in order to do that buy down. Well, if you did a 1.0 buy down for the same thing, it's only $2637. Now they would only get this 5.75 rate for 1 year, But still, if you're in a case where you had negotiated a certain amount of seller credit and you had 2637 left over, you could apply it to a 1-year buy down and get them the lower rate for the first year. So it's another option. Another thing to note here is, so like in this case, if you're buying a lot of buyers in this price range, 334, 200, so your down payment is about $12,000. Well, and they're having to come up with 18,000 because we're using the seller concessions in this case to do the buy down, but it's not covering their closing costs. So they're going to have to pay their own down payment and their own closing costs in order to make this work, unless you negotiate that additional money on top of the 2-1 buy down. So it could be a much higher concession that's needed from the seller in order to make that work. That's just another look at it. Okay. So we have a calculator. It's just an Excel spreadsheet that we could plug this into and figure out the numbers specific to each person. Like a 3-2-1 buy down, I just thought I would show you this, how much more it is. It basically comes to like 4.5% of the sales price is what you would need to cover the 3-2-1 buy down. The cool thing is they would end up with a 3.75 rate for the first year, which people would love that, save $750 off the payment. But I mean, that's $18,000 of money that's needed from the seller. FHA will allow up to 6%. Conventional loans only 3% with minimal down, but if they're putting 10 or 20% down, then they might be able to get 6 and up to 9% seller concessions. So it's going to just depend on each buyer's scenario, how much they're putting down and stuff on whether this is going to work or not to do the bigger buy downs. Questions or anything on that? Let me know. You could unmute yourself or put it in the chat. Okay, another way of looking at this, I just want to, now this is a lot of math, but just briefly, I want to show you that for that same scenario, basically what I'm showing you here is that, so that 2638 payment, and then that price, so if somebody was to take, say, 10,000 off the sales price, that's going to lower their monthly payment 76.66, okay? If they were to put it towards a permanent buy down and buy their rate down, so you could take the same amount of points that we use for the 2-1 buy down and use it on a permanent buy down, you know, back to this one and say, okay, well, we could buy them down to say, you know, it was about 2.25. Yeah, it was about 7,800. So, I mean, you could buy them down to like 6%, 5.9, maybe 5.8. So you could do that for a permanent buy down, and that would be a way to go. So like say you got them down to 6%, that's going to save them $165 a month. In order to have the same impact on their payment of the buyer as this rate reduction of doing the buy down, you would have to lower the sales price by $26,000 to save $165 a month. So it's much more cost effective for the buyer and the seller to do a rate buy down, to agree to a rate buy down, than it is to reduce the sales price off the other side. So for a buyer that's getting financing, the seller concessions make a way bigger difference than a discount off the price. These kind of flyers right here are a really good way of marketing your listing, of getting the info out there. And if you scan this little QR code on here, then it takes you to a page that gives you all the information, gives you a walkthrough, all the pictures of the property and stuff like that. And so if you guys have any listings that you want to co-brand some marketing on, I would love to do that with you. Offering this strategy to buyers as a way to get into the house with a more affordable payment is just a really great option right now. And we have a database of a lot of people that have gotten pre-qualified and then just not ever gone under contract, not moved forward. So I know there's a lot of buyers out there that are on the fence. And the biggest thing is affordability right now. So they feel like the payment's too high, they can't afford it, and so they just wait and don't buy. And so if we can get a few buyers off the fence by putting a strategy like this together, then I think it can make a big difference in the marketing. The other thing that, so we have a few different ways that we could collaborate together. If you're not getting my emails, make sure to just send me your email address, and then I'll make sure you're on my email list. First Wednesday of each month, we're going to be doing webinars like this moving forward for the rest of the year. So the next one's July 3rd, I think. I'll send out a notification on that. You can also, I'll put it in the chat. If you want to make sure you could get this on your calendar, here's a link in the chat where you just fill out the little form and then that'll add the recurring appointment to your calendar for the rest of the year for these webinars. And we're going to have different, whatever comes up that's interesting and that's making a difference in the market. I'm going to share those on these calls. Co-marketing listings we talk about. Co-branding on HomeBot is something that is a great idea. It's a monthly homeowner digest that goes out to your clients so you can load your past client database into it and then they hear from you every month. I'm always hearing from clients. I just talked to somebody on Monday that had moved to Phoenix and he's thinking about moving back to Yuma now. And he's like, yeah, you've done a great job of keeping in touch with me. And I'm like, I don't think I've talked to you since you since you closed on your Phoenix house, but he gets the HomeBot every single month. It's a personalized email that has your picture on it and it talks about their house. It has the numbers and people like it. Our open rate's over 80% on those emails. So it's super low cost. And if you want to get on that and load your database into it, I would highly recommend it. It's a great way to stay in touch with them. And then top-notch lead conversion. So my team has been hyper focused on lead follow-up and lead conversion lately. And so we're putting a whole process in place and automating some of the lead follow-up to make sure that nobody falls through the cracks and we keep in touch with them proactively and on a very consistent basis. So we'll plug any buyers that you have that need help with conversion. We're going to plug them into our system. I try to meet with everybody in person or over Zoom personally in order to give them the full workup of my opinions of the market and answer any questions that they have and give them really just a buyer consultation where they feel heard. We answer their questions and it's not a sales pitch. It's really a consultation to help them to feel comfortable about the decisions that they're making. And then from there, we'll load them into our CRM so that the ball doesn't get dropped on them. And so we'd love to work with you. If you have any buyers that need to get pre-qualified, let's collaborate. Let's work together on them. And I think that's it. Anything else? Any questions from anybody? Paula, anything in the chat? Anything else you want to add?
I liked it, Daniel.
Okay.
We look forward to working with y'all.
Yeah. All right. Thank you very much. Have a great day, guys. We'll see you later. Bye.